Welcome to the second part of our 2019 year-end planning for investors series. This overview will discuss recession. We hear a lot of talk about a potential or upcoming recession. Please think about the word recession. What comes to mind? Would it look something like this? So what is a recession? Well, first let's review the business cycle. The business cycle is the upward and downward movement of the gross domestic product, or GDP. It refers to periods of expansion and contraction in the economy over several months. The business cycle is a repetitive cycle that consists of four major phases. They are expansion, peak, contraction, and trough. So, once again, what is a recession? A recession is a decline in a country's gross domestic product, GDP, for 2 or more consecutive quarters of a year. It merely is a slowing of growth, and not a total elimination of growth. Recessions can be mild, moderate, or severe. A depression is a long and severe recession. Let's quickly look at the 5 U.S. recessions since World War II. There was 1973 to 1975. This was primarily caused by the oil embargo in Middle Eastern countries. Then, 1981 to 1982, which was primarily caused by inflation and rising gas prices. Next, 1991, which was caused by the first Iraq War and rising gas prices, and 2001, which was caused by 9/11 and the dot-com bubble. The latest recession was in 2007 to 2009, and that sadly was labeled the Great Recession because it was bad. Unfortunately, many investors were spooked by the equity losses during that recession, and some suffer from recency bias. Recency bias is something that psychologists warn against. Recency bias is the phenomenon of a person most easily remembering something that has happened recently compared to remembering something that may have occurred a while back. Let's review 2 normal investor experiences: corrections and bear markets. A stock market correction is traditionally defined as at least a 10% decline from a recent high, with a bear market representing a minimum 20% pullback from a high. Remember, equity market corrections are a part of the investing experience. Since 1950, the S&P 500 has undergone 37 separate stock market corrections of at least 10%, not including rounding. Considering that there have been over 69 years since the beginning of 1950, this works out to a correction on average every 1.87 years. So the possibility of a market pullback or correction is always there for investors. Other concerns right now include tariffs. Tariff actions with Mexico, Canada, European Union countries, and China have left some investors concerned. These tariffs and the potential for more and their impact on equity investors are now a significant potential concern that we need to pay careful attention to moving forward. Political uncertainty. All you have to do is turn on any news station and you'll hear about the political uncertainty that is out there. And global financial issues. Some developing countries are struggling, and other foreign countries like Turkey are going through difficult financial times. When reviewing investment holdings, managing these risks is something we attempt to evaluate as we assess holdings for our clients. Try to avoid the temptation of chasing investment returns. Instead, try to focus on your personal financial goals and how you are progressing towards them. Thank you. We appreciate the opportunity to assist you with your financial needs.